ask you a question. Is anyone here aware of or familiar with the policies at your particular bank regarding financial statements and their submission, personal financial statements? Nelson, I'll come back to you since we were talking about credit analysts. What is the policy of your bank when you are receiving personal financial statements? Do you have your own form that you provide to your prospective or current clients, or do you allow them to submit their own from maybe a software that they have or something, use another bank's form? What's the policy?
On our side,
Okay, Isaac, go ahead.
We can take it a number of different ways. We have one form that is extremely similar to the one in the book,
yes,
which is for larger transactions. We have
right.
a simpler one for smaller transactions, typically 100,000 or less.
Or less, makes sense.
And
okay.
we also have a very short form that they sign, which allows us to use another bank's personal financial statement or their self-prepared one if they need one.
Okay. Okay. All right. Thanks, Isaac. Anyone else wants to quickly share? Justin, what's your bank, if you're aware or familiar, what's your bank's policy regarding personal financial statements?
We have a form that we give them. We prefer them to use that.
Yes.
The questions we're wanting to ask.
Yeah.
And we have them sign it.
Okay.
I have accepted other ones on different forms, like maybe just a blank sheet of paper with assets and liabilities, balance sheet, stuff like that. So,
okay. Yeah. Okay. All right. And so what you're sharing with me is what I expected to hear you say, because I'm not going to go through in details the sample that your textbook provides. I mean, talk about RMA influence. That is another impact that RMA has had. So you notice that that document is very detailed. I will tell you that when I was in banking, the personal financial form was not as detailed as the one that is in your textbook. Having said that, I have been at banks where they do have forms that approximate the one in your textbook. So it clearly is a function of the bank and how important that particular document is to them. And so I'm going to share some additional ideas with you, but it's all centered around asking the right questions, knowing what you should be getting from your client, and then being prepared to ask the questions. So I'm just going to quickly share a couple of things here with you, and that should be it for this afternoon. All right, so as usual, I take the chapter and I turn it into a question. And so for this chapter, the question, of course, is what are some of the guidelines for analyzing personal financial statements? And I just wanted to reinforce that when we talk about personal financial statements, we're talking about a summary of the financial position of either an individual or a couple or a group, right? Which is distinct from the financial statements of a business. And so we're not talking here about doing business as, right? We're talking about an individual, or it could be a couple, or as I said, it could be a family or related group members. And what we are looking at is the financial position at a specific point, right? It's a balance sheet. And so just like your corporate or business balance sheet, it's supposed to tell you what their assets are, their liabilities, and their equity or net worth on a specific day. The day before, it could be different. The day after, it may be different. But on that particular day, this is what it is. I will tell you, though, that this is probably one of the more challenging financial statements to deal with. And do not take this as a political statement of any kind. I'm sharing this for two reasons. One, when I was a credit analyst / commercial lender, the bank I worked for was part of the consortium that loaned money to Trump and his company. And so when he first filed for bankruptcy, well, not Trump, but his company filed for bankruptcy, you know, my bank was one of those that said we had more to lose if we tried to collect on the loan as opposed to having him go through the bankruptcy courts. And so, of course, that's what happened. But this, you may be familiar with the most recent situation where the accounting firm that is or has been responsible for generating his financials, they have said, look, we are going to back away from this individual because clearly there are inconsistencies with regards to how assets, specifically real estate assets, are reported. And by the way, this is not unique to Trump and his company, because when you ask an individual to prepare their financial statements, what do? They sit down and they literally make up numbers, right? Because the average individual is not necessarily going to have a software that is tracking their financials. So you're asking them for assets, you're asking them for their debts, and then they're saying, well, I think my asset is worth this. So you really have to dig to get to a point where you are comfortable with the financial information that you get from individuals, right? So here are some general guidelines regarding the financial statements. As far as accounting standards are concerned, it's driven by Statement of Position 81-2, and it says, among other things, that personal financial statements should be prepared on the accrual basis, not the cash basis. So it's quite acceptable for an individual to report an asset receivable. Okay, so it could be a receivable from a friend, it could be a receivable from another company. They are allowed to put that on the financials because it should be based on the accrual method and not the cash method. So there is consistency there with regards to generally accepted accounting principles. The other thing that you want to bear in mind is that whereas prior to 1982, the accounting profession required historical costs, which means that you report assets at the purchase price, lenders such as yourselves are the ones who mandated a change. And so in 82, the AICPA said, okay, we will make it so that what you report as the value of your asset is the estimated current value. What does that mean? It means that this is the price that a willing borrower and seller would agree on. And of course, that sounds great in theory, but how do you arrive at that number? Well, some of these values are going to be easier to determine their accuracy than others. For example, cash. That should be easy to determine if you're talking about cash in a bank account, right? Because you can get a copy of the bank statement. If you're talking about marketable securities, these are securities that are sold on a major stock exchange. That's easy to verify. How could you verify the value of, say, marketable securities that are traded? What would you do in order to verify that information? What could you do to verify that information? Any suggestions?
You should have a monthly statement or some quarterly statement coming to them with that. Exactly. There would be statements. If they have a brokerage firm that they deal with, they will get monthly or quarterly statements. And of course, you could then verify the value. And even if they don't have the statements, if they provide you with details about the stocks, you of course can go online
and obtain the value of those securities. Maybe not necessarily at the date of the financials, but you could at least get an updated approximation as to what the values are. The problems would be with those securities that are not publicly traded, right? And so now you may have to look at what other entities that are in a similar area, what their stocks are or bonds are being traded for, and determine a value that way. But again, it's all about asking the questions. And so when you're looking at the assets, you're looking at three major things: the liquidity of those assets, the ability of the owner of the assets to meet their short-term daily expenses, if you will. Then you're also looking at solvency. Can they meet all of their obligations? Okay, so this has more of a long-term perspective when you talk about solvency. I mentioned this last week. And then the other thing is marketability. Is there a market for the asset? For example, if they have bonds, oh, that's easy, right? There's a bond market. If they have stocks, that's easy. There is a market for that. Well, is there a market? Are there buyers and sellers available for that particular asset? So that's what you're looking for when you are evaluating assets. Are they liquid? Are they solvent? Is there a market? And liquidity and solvency don't necessarily go together, okay? You can have a situation where a company can meet their short-term obligations, not a company, an individual can meet their short-term obligations, but not their total obligations. So they're liquid, but they're not solvent, okay? So one doesn't automatically lead to the other. On the liability side, similarly, oh, and I should mention one more thing about the assets. This is when you're really diving into the details of the assets. You're trying to find out if there's a long-term receivable, for example. Let's say they were showing a receivable that they're going to be collecting over 2 or 3 years. What you want to do is discount that. And I know we're getting into a little bit of details here, but what you're trying to find out is what is that worth today? And so maybe you would use the interest rate that is associated with that particular receivable, and you calculate what is called the present value. Don't know if anybody here has done finance, and I'm not going to get into the details of that, but essentially you're trying to figure out what is that receivable worth today, not 5 years from now, right? But today. And so it's called discounting. That's one of the things you would have to do if you have any long-term receivable. And then I think I mentioned already, but if I didn't, I will say it now. The assets should be listed in the order of liquidity. So if I ask you to prepare a personal financial statement for an entity, for an individual, be sure that you list the assets in the order of liquidity, meaning you start with the most liquid, cash, for example, and you end with the least liquid, okay? And the least liquid would be any asset that doesn't have a market or has a very limited market. On the liability side, you go in the order of maturity, meaning that you start with those that are going to be due very soon, and you go down the list until you get to those that are due maybe several years out into the future. So for example, if they have a credit card, I would put that ahead of, say, a mortgage, right? Because if they have a 30-year mortgage or a 15-year mortgage, that would be a longer maturity, so come lower than, say, a line of credit that they may have or a credit card that they may owe a balance on. So those are some of the key things that you should bear in mind. Now, this is not something that you would necessarily see on the average tax return, but you see right here where I talk about income taxes. If you are fortunate enough to get a CPA prepared personal financial, this is one of the things that they would calculate on the financials. They would show what the estimated taxes would be based on the tax base of that asset compared to its current value. Okay, they would go through that calculation and record it as a liability. But of course, they would have a provision that says the actual income tax payable would most likely be different from the amount calculated on the financials. But if you just have someone sit down and prepare a personal financial statement, they're not going to have that line on there unless maybe they just filed their taxes or they're filing their taxes and they haven't paid the taxes for the 2021, for example, tax year as yet. And of course, as you know, the net worth is the difference between all the assets and all the liabilities plus the estimated taxes. Any questions before I go on? Again, the chapter itself is fairly self-explanatory, but I just wanted to emphasize a few things. So this is actually a financial statement, a personal financial statement prepared by the AICPA. And they show you, of course, that the assets are listed in the order of liquidity. So you can see that the first line item there is cash. And then you have a bonus receivable, which is perfectly legitimate because it's on an accrual basis, right? So you can show receivables. And then it goes into investments. And again, these investments, you will have the ones that are marketable. They would appear before the ones that do not have a ready market. And then you have cash value of life insurance, which of course, they're even giving you details that it is the net of any amount that has been built up as cash minus the amount borrowed against that cash value. Of course, you know that this is only possible if you have a whole life policy, right? A term life would not provide you with a cash value of life insurance. And again, it ends with the least liquid of the assets. And you notice that this particular set of financials, they reference notes. You will not be getting notes if you were to get someone to sit down and prepare financial statements on a piece of paper, but at least your notes would be the questions that you ask them, okay? But again, on the liability side, it is going to be based on the order of maturity. So the ones that are due immediately or within the next few months or less than a year, they're going to be first until you get to the ones that have a longer maturity. We do not have current assets and long-term assets on a personal financial statement because it's not subject to periodicity, which is that principle in accounting that says you can break up the life of a company into years. So we don't talk about current assets and current liabilities, but we do talk about the order of liquidity and the order of maturity. All right, and see that estimated tax I was telling you about? That's a critical calculation for major net worth individuals, but you will only get that if you were to get CPA prepared personal financial statements. So this net worth is the difference between all the assets and all the liabilities. The other thing too that you get with a CPA prepared personal financial statement is that they will do essentially, it's like a statement of cash flow, but it's not, okay? It's a reconciliation, a statement of changes in net worth where they tell you why the net worth changed. For example, if you come back here, you notice that the net worth went from 921 to over $1 million. Well, what caused that change? Well, the simple answer would be assets went up, and even though liabilities went up, clearly the assets increased by more than the liabilities, and that's why your net worth is larger. But that's just a summary statement. This would give you the details. Again, if you're lucky to get CPA prepared personal financial statements, it would have this kind of detail. But unlike a statement of cash flow that reconciles to the statement, the changes in cash. So for example, if we were doing a statement of cash flow, we would try to explain why cash went from here down to here, right? But with the statement of changes in the net worth, we are reconciling the change in the net worth. So these are the factors that cause the net worth to change. So it shows you the increases in net worth resulted from these items. And so questions that I would want to ask would be, what can we expect regarding salary? You can see that the salary did go up, but was it because of the bonus, or did this person get a raise, right? So we want to be questioning these kinds of things. Dividends, again, we can look at these in terms of the marketable securities and see what the likelihood is that such income would continue, and on down the line. Then here you see factors that cause the decrease in the net worth. There was an increase in taxes, which makes sense, right? Because any increase in your liabilities would cause your net worth to go down, whereas increases in assets would cause it to go up. Of course, decreases in assets would also cause your net worth to go down. So again, I'm just showing you that if you were fortunate enough to get a CPA prepared personal financial statement, good luck, then you would be able to get a lot more information. But you know, let's not despair, right? Because you can ask questions based on the information that you do have that would allow you to get an approximation of what's really going on. So even if you were to be using the financial statements as appears in your textbook, if you ask the questions about the expenditures, what's the likelihood of this continuing, right? You see mortgage payments. How many more years do you have left on the mortgage? Those are things that you would want to question. Do not just accept the numbers as they are. And so I'm ending with this just to show you what the notes are like, okay? And so think about the notes that are a part of the CPA prepared financial statements as answers to questions that you would have asked, okay? So note 1, for example, you know, addresses items on the preparation of the statements. You can see there's a breakdown here of the securities. You would be able to get this kind of information if it's marketable securities. And as someone said, get a copy, right, of their most recent statement. It could be a monthly statement or it could be a quarterly statement. But again, as we said from day one, your job as an analyst is to ask questions after questions. And so you will notice that your assignments keeps asking you, what questions would this person need to ask dry supply? Because to the extent that you can ask great questions, you are going to be able to do a much better job. All right, so I don't know how I did on time here, but if we do have any time remaining, I will gladly take any questions that you may have. Does anyone have any questions? How are we on time? Nelson, do you have a clock or a watch that you can quickly tell me what time it is? Is it 7?
It's 6:02.
You said it's 7?
7:02.
Okay, all right, so my time is up. All right, any questions as we wrap this up? As I said, I think that this chapter is one of the easier chapters. Just to give you a heads up, we're going to continue with our discussion of personal financial statements in the next chapter, if my memory serves me right. and we're going to be going back to ratios. Okay.